Procter Gamble, a household product multinational, has seen an uneventful financial performance in 2022. The company's revenue declined by 1%, indicating a slight decrease in sales, and its net income saw a drop of 1% year over year as well. Additionally, the stock price experienced a decline of around 0.5% year to date. Today we'll take a three-step approach to thoroughly evaluate Procter & Gamble and determine its fair value. Step 1. Margin of safety. In this step we'll look at Procter & Gamble's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into Procter & Gamble's financial statement and assess critical metrics and ratios. In step 3 we'll be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of Procter & Gamble's business. By using these methods, we can determine whether the stock is currently overvalued or undervalued in the current market on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of Procter & Gamble as an investment opportunity. To determine the final value of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. Margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. First metrics that we'll be using are the margin and EBIT growth. The EBIT has gone up over the years, going from just over $14 billion in 2013 to $18.6 billion in 2022. The average EBIT growth during this period is 3.4%, which is no change in the margin of safety on this metric. The margin has increased over the years, going from 17.6% in 2013 to 23.3% in 2022. The average margin growth is 3.3%, which, looking at our scale, is a 5% deduction from a margin of safety. The next metrics that we'll be looking at are the dividend growth and payout ratio. The dividends have gone up nicely over the years, going from $2.10 a share in 2012 to $3.65 a share in 2023. The average dividend growth in this period is 5.2%, which is no change in the margin of safety in this metric. Looking at the payout ratio, it's currently sitting at 63%, which once again is no change in the margin of safety on this metric either. The final two ratios that we'll be using are the debt to EBITDA and return on invested capital. To get the debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for Procter & Gamble, this is just over 1 year, in this case a 117% debt to EBITDA ratio, which is in the green part of our scale, indicating a 5% deduction from margin of safety. The return on invested capital for Procter & Gamble is currently sitting at 13.4%, indicating that the management is very effective at allocating capital, indicating once again a 5% deduction from a margin of safety. Looking pretty good so far for Procter & Gamble. Let's look at the valuation models next to determine the intrinsic value of the company. The first model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Procter & Gamble going from 2013 to 2022. The average growth rate in their free cash flow annually during this period has been sitting at almost 4%, and I'm projecting their future free cash flow to grow by 3% annually for the next 10 years. And with this percentage, we'll determine the future free cash flow for Procter & Gamble and determine a terminal year of valuation, using a perpetual growth rate of 2.5% and a discount rate of 8%. This gives them a sum of free cash flow of just over $250 billion, and all that's left to do to get an equity value is to add the cash and equivalents and subtract the debt, giving us an equity value of almost $227 billion, and dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $96.11, which is almost a 37% downside out of this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Procter & Gamble going from 4 years ago to the current year. The average growth rate in the dividends during this period has been 6.25% annually, and I'm projecting all of their future dividends to grow by 5.5%, and we'll be using a discount rate of 8% once again in this valuation, giving us a dividend discount model price per share of $154.17, which is just over a 1% upside out of this model. The next model that we'll be looking at is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Procter Gamble is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that the PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value of $73.22, which is a 52% downside out of this model. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Procter Gamble, take a look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 33.79. All we have to do then to get a fair value out of this model is to multiply by the earnings per share that Procter Gamble is generating, which is $5.76 a share, giving us a fair value of $194.64, which is a 27.61% upside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 2.61%, while the current yield is sitting at 2.46%, indicating that it's slightly overvalued on this metric. Doing the same with the PE ratio, the average PE multiple of the past 5 years has been sitting at 29.19, while the current PE ratio is sitting at 26.48, indicating that it's slightly undervalued on this metric. Looking at the deviation from both of these, we get a fair value of $155.84, which is a 2% upside of this model. Let's go look at the final overview of a valuation next. Looking at the final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $134.80. Margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting by 5% for the debt to EBITDA, margin growth, and return on invested capital, leaving us with a 10% margin of safety. Applying this margin of safety, we get a fair value of $121.32, and with the current price of $152.53, we get a downside of just over 20%, indicating that it's currently a sell per our valuation. If we look at the price action of Procter & Gamble, we can see that the fair value that we've determined has not been the price for a very long time. The last time it hit this price was during July 2020, which was of course in the pandemic years. For this stock to hit our fair value, it would have to make a significant drop, which is not very likely, seeing as this is a very low beta stock. And you have to keep in mind that Procter & Gamble is a dividend king, so usually there is a premium added to the price of these stocks. If you want to get access to all of the valuation models that I use in this video and much more other valuation models, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.